It's pronounced Nisai.
Oh,
Can you hear
Nisai.
me?
Okay. I gotcha. I
Yeah.
gotcha. All right. Yeah. Thanks for coming on, man.
Oh, yeah. Yeah, no, thanks for
Yeah.
all the value. And it's not a she. He said she's on here. I was like,
Oh, yeah.
I'm
Oh,
a
no.
guy, but
I
it's
mean,
all
I
good.
apologize. I didn't know how to pronounce your name. If I knew how to pronounce it, I would have never called you a she. So my apologies.
No, that's okay. No, thank you for all the info. I mean, it's such an eye opener to just the surface level that I've just been, just doing my own independent research on over the years. So thank you first and foremost. I think it's very valuable what you're doing.
Yeah, and I think you're getting enough detail, right, and kind of walking through things. And some people are capable enough of taking this information and running with it on their own, and that's beautiful. Like I say, either way, it's about collaborations and partnerships. So, one way or another,
Hmm.
it's you'd be amazed. People think they're in competition when they're a multifamily investor. You're not. I mean, because as I was mentioning with Brett, as you go larger, you're not taking down deals alone, right? So what ends up happening is who maybe your competitor one day on a deal ends up being your partner on another one. I mean, it happens all the time.
Right.
I can't even stress that enough when you get a little bit larger and get into that space. So I know
Yeah. Yeah, I agree.
you're looking for your first deal, but you've done one or more kind of single family things. Is that what I'm understanding?
Yeah, so my background is real estate like yourself, realtor. I've done my own flips. I'm also a general contractor. I came from construction
Beautiful.
in my past life and just kind of, one hand feeds the other. It's just overlaps kind of naturally and,
Yep.
helping clients buy, sell, invest, and then do my own investments and flips and raised capitals to do flips on single family homes with under 12 months, 9 months, 6 month flips, right? So giving some double digit returns to my clients over the years have been, you know, good for them and myself. Kind of slowed down on what I've been buying in the last 2 years since the rates have been high. I've been really selective on anything that wasn't a home run or a slam dunk deal if it didn't give me that margin that I needed. And plus, um, I'm not really looking. I'm just trying to play it safe and just want to see how the market kind of unfolds as we get
Yeah.
closer to the rate changes. And so now
Yeah.
I'm looking to
What
shift
markets are you? What markets are you in currently?
Orange County and LA.
Okay. And that's where you've been doing most of the flips and stuff?
Yeah, yeah,
Okay. Cool.
yeah,
Yep. Yeah, and those are great markets. I mean, obviously, we're not too far from you currently down here in San Diego. And like you said, you have a background with some high net worth folks that you've been moving money through on the flips and getting them their returns. And so you've created a great little network, right? And now
yeah.
your natural gravitation is into the multifamily space because in the flipping business, in your world, even as a realtor, I mean, you're in the active money, right? And so you're in California. So if you are not careful with the flip money, you can get hosed on taxes because you have short-term capital gains, right? So you can make
Right.
great money, but if you don't, you're in California too. I mean, we're getting,
Beat
bent
up.
over pretty
Yeah.
good. Both federal and state. So it's setting that up. Um, a good avenue for you is number one, you're going to have to go out of state. You know that.
Oh, 100
And
percent.
whether that's Arizona. I mean, even with I can tell you all the folks that are in the community that are in California are either in Arizona or the Midwest. Like I said, logistically direct flights, as I was mentioning with Brent, because
Yeah.
I don't want you living in airports if you're going to have to do some travel in the beginning, right? In the beginning to get things set up. And like I said,
Yeah.
once it gets on autopilot, I mean, there's properties I haven't been to in a year. Okay. But we do our weekly ownership meetings. So I'm there doing the asset management stuff with the property manager, making sure all the numbers look good because the data doesn't lie. Right. And when we
Right.
talk tomorrow on the property management side, I'm going to tell you that there's 4 reports. And those 4 reports will tell me everything about the property's performance as to where it's at now and where it's going to be 90 days from now, period. And it's amazing
Mm-hmm.
how few property managers that actually manage properties know how this works. It's
Yeah,
crazy
I
to me. I'm
bet.
like, bro, should I do your job? I mean, this is nuts. You run a property management company and you don't even know these things. So anyhow, we'll get into that tomorrow. But I think for
Yeah.
you, and you're looking to make this leap, number one, yeah, direct flight within 2.5 to 3 hours from you. And then it comes down to, if you have 30 to 50,000 bucks, then where you could actually go in yourself and then lock up a deal, and or you have a partner, right? If you like me in the beginning, I was getting hosed. I didn't have the capital, so I had a business partner that I actually created our capital company with. And then
Mm,
now we split that capital company 50-50. They actually brought in the money. I was kind of your little bird dog, right? I
right.
was the sweat equity guy running around finding the deals, making things happen, doing all the hustling. But for that, I earned my equity in, right? And that's how at least we got started. So if you have access
Mm,
to a partner like that, that's another avenue in if you don't have a lot of this capital yourself. Okay. So
mm,
like I said, don't
okay.
ever let the money stop you, right? It's very easy to get stopped by that. I mean,
Yeah.
it's understanding that if you can go find great deals and you know the process, like you have that skill set and that process to go make this happen and put it all together, and you're savvy enough, like Rudy was talking earlier today. I mean, no college degree, no nothing. I could find good deals and I could put people together to make things happen. And I didn't
Right.
worry about whether the how. I just knew I was at A. I wanted to go to Z. I was going to make it happen. Period. So I think it's a key component. But then, yeah,
Thank
you
you.
looking in states in the Midwest, and then I would keep the flipping business because we flip houses,
Oh
right?
yeah, I bet
Flipping
you
is
do.
not a bad thing because that gets you the transactional money. I mean, even in fact, I mean, we even created our own fund. It's a $25 million fund, and that invests in multifamily as well as a very specific model that we have for our flip business,
Mm,
right? And so we have a very specific model for our flips, but we'll take 25% of the money that comes into our fund goes to the flips. 75% of the money that comes into the fund goes to multifamily. And that's how we've
got it.
divvied it up because that allows us to capitalize on two things, right? The consistent cash flow and give those returns to the multifamily, the tax benefits, all that bonus depreciation stuff we're talking about. And then we pass
Hmm.
that back to all of our investors. So they love it. And then the flip game gets our investors, like you said, the higher returns and the higher velocity return on the money.
Right.
So then you're kind of blending these two things together, and we created our hybrid fund. And you, like, when someone invests into that thing, they're getting the blend of both deals, if that makes sense.
So my question, and that's valuable stuff. No, thank you. My question, where I'm getting hung up with these higher net worth individuals, is kind of what I put in the laser the
Yeah.
information that you guys, the questionnaires, them asking, hey, how am I protected?
Yep.
If I'm investing 150, 200,000, 300,000, whatever that is. Some people, like, the language that you have in your contracts don't, have much protection. And this has come from I'm not going to say their name, a business owner who all they do is litigation. So she owns a company that, uh, she's not a lawyer herself, but there's hundreds and dozens of lawyers that work in her company. So she's like, I'm
Yeah.
surprised you guys don't have like a investor disclosure statement. And I go, yeah, I think we could, adjust these terms in the contracts to make it more favorable, at the end of the day. But,
Sure.
like
Well,
you
yeah, you're
said
talking about you're
earlier,
talking about your flip. You're talking about your flip contracts.
yeah, flips,
Okay.
developments, and then even
Yeah.
going forwards to multifamily. I want to have my bases covered so I can explain it and deliver that message, thoughtfully.
Yeah. Okay. Beautiful. So when you do multifamily and you syndicate a deal, right? And you're raising money from people, some people you know well, some people you may not know well. Just depends.
Right.
But in order to do this legally, right, there's a process that you go through, what's called under the SEC guidelines. Okay. I'm going to jump a little higher level for here, but this is really important for people to understand the syndication game of multifamily. Okay. So when you do this, you're going to have what's called a private placement memorandum. That private
Okay.
placement memorandum includes 4 documents. You're going to have the offering, you're going to have the operating agreement, you're going to have the subscription agreement, and then you're going to have the questionnaire.
Yeah.
Okay. Now, these are all required by the SEC, and it's in a nice little package that are put together by a securities attorney, all of which, people get when they come into communities and you do these things. This is
Got it.
all put together, and this is what protects you, and it's what protects your investors. It lines everything out beautifully. And the SEC has put this in place, right, to ensure that you don't take grandma's last 50 grand and run off, and then you're on some American Greed show in 2 years, right? I mean, that's the whole concept behind it. Is they
Right.
say, hey, if you're going to raise money and do this game, you can do it, but you're going to do it under what's called a Reg D, right? That's a Reg D filing with the SEC that gives you an exemption. So that way you don't have to go file on the public stock exchange. Now,
Got it.
once again, getting into a little bit of the weeds here, but it's not really that complicated. But if you haven't seen this before, you're like, holy crap. Don't worry. It's very, very common. Everybody does this. This is why you have an attorney put it together, and it's all packaged, and there's like a price for it. And first of all, the deals pay for it, by the way. Okay. So it's a Reg D filing. They do all these documents for you, and then you would put it into what's called a 506. In your case, it would be a B offering. This allows you to raise money from accredited and non-accredited investors. Okay,
Right.
accredited and non-accredited investors. And that's pretty much how the game works. And so this is how your regulation attorney friend person, they would have all these documents. And they may have 14 million questions, but just understand that it's pretty common, and this is how these things are put together. And that allows both people to be protected. Now, keep in mind, they're an equity investor, so there's no guarantees on their money. There's no guarantees on your money. There's no guarantees you wake up tomorrow, right? But
Yeah.
it does set in place some fundamentals of, hey, this is how we're going to invest in the deal. That's what the offering's going to tell them. This is kind of the debt we're putting into it. We're raising X amount of money, and then we have a loan at 70% or 60%. So what it all ultimately comes down to is, what kind of property are you buying?
Hmm.
Is it cash flowing today and producing income? And you can show me those numbers. And then I'm coming into it, so we're not over leveraged, like I was talking before. You don't get over leveraged. You're buying it at 60, 70% leverage and debt. So there's plenty of equity in it. And you're cash flowing that thing beautifully from day one. So that property's paying for all the expenses, property taxes, insurance, everything on it, property management fees, all your mortgages, everything it's paying for. And then there's cash flow at the end of it, and that cash flow goes to you and your investors. And so it's no different than any investment. That investor is going to look at it, see if they like it, and if they do, they'll invest with you, and then you would bring it through these documents to make it happen. Okay. So, there are
You.
certain cases, FYI, there are certain cases where you may not do the full blown kind of syndication
y-
thing here.
right.
It may be a small enough deal to where it's just you and a few other close friends and people you know. And then under that situation, you would just do an operating agreement with an LLC operating agreement and put everybody into it and spell it all out.
Yeah.
Yeah.
And that's pretty much what I've done since, is just like the
Yeah.
operating agreement and a JV and an LLC.
Yeah. Yeah. And
Okay.
yes, Marty, it is accepting and stuff. I normally don't pitch our own investments on our 3 days, but happy to talk to you about that. Yeah, 100%. So, but yes, that's how you would protect yourself and your investors. And it's all
Okay.
designed to do that. And then it's guided by the SEC rules and regulations. So if your investor friend is like, is this regulated? Yeah, it's regulated by the SEC.
Yeah. You ever had anybody kind of ask the same questions when you say, hey, like, is my money protected? It's like, no, nothing's guaranteed. And
Well,
it's
yeah, I
like no
tell them,
risk,
like,
no rewards, but this is
well,
calculated risk.
yeah, and it depends. I said, if you want to come in and be a lender, right, then we can actually record your loan on the property. That's an
Yeah.
option, but it's going to be a different setup, meaning your returns are going to be 5, 6, 7% because
Yeah.
you're a lender. You're collateralized and protected by the asset. You're typically in a first or second position, meaning, and I'm getting into a little high level here, but first or second
Yeah.
position on the property. So that way I'm not going to give you the upside. You're getting no upside. You'll get an interest rate on your loan, and that will protect you because now you'll be an actual deed on the loan,
Yep.
or I'm sorry, deed on the property, excuse me. And that way, if
Yep.
heaven forbid anything happens, you can foreclose on the property and take it back and get your money. I mean, that's another
Right.
option for you, but your interest rate's only going to be 5, 6, 7, 8%, right? So they're limited in their return. But then you might as well
Yeah.
just be a lender, right?
Okay. So that's like,
Versus an equity partner, right? There's
yeah.
differences because if you're a lender, then you have a loan on the property. It's protected better, but that means because your risk is lower, your return is lower. It's
Right.
very simple risk reward balance. So if she wants
That's a good way.
if they want ultimate protection, then their return is going to be much lower because your risk is lower. But if you want
Makes sense.
bigger returns, then you're an equity investor, which means now you can get 15, 18, 20% a year on your money, but it's protected by a great asset that's cash flowing. So it's, once again, it's calculated risk. That's all it is.
Yep.
And
Yep.
it's risk reward based on the property. And once again, you're not buying some speculative deal. Like you're buying something it's a business. It's no different than you going and buying a Subway, right? The thing has an income, it's got expenses, and it's got a profit. That's it. You're buying an apartment building. It's got revenue, it's got expenses, it has a profit. You're buying an operating business that just happens to have people living in it.
I like that. I like that.
Yeah.
That was a great nugget. So thank you.
Yeah, you bet, man. Because that's how you can kind of get across to the investors and get them comfortable that, once again, we're not being speculative or crazy. Like we have low leverage, cash flowing today, buying an asset that's its own business. We're going to make all this stuff on it by doing it. We just need to make sure we stay on good fundamentals. So, yeah. Cool, man.
Great
I hope
stuff.
this was helpful for you.
Thank you.
Yeah, let us
Thank
know if
you.
we can help, and be here tomorrow. We're going to go in through all the property management and then the due diligence side of it. So, presuming, hey, we've locked in a deal, we're going through the escrow. Like, what do I need to pay attention to? So, should be great. Awesome. Then I know we have Ade. Is